Today's lecture is net working capital, and this is one of the more difficult concepts we run into with capital budgeting and introductory finance. So I've tried to give you some detailed notes here on these slides, and I'll talk a little bit about some of the notes, but a lot of this will be just reading through and then trying to work a few examples and figure out how net working capital impacts a project. Well, what is net working capital? Net working capital is essentially accounts that are used to support operations for a firm. And the way we calculate it directly is it's current assets minus current liabilities. Now on the current asset side, we have things like cash, accounts receivable, and inventory. And if you think about these items, these are all accounts that bring money in eventually, just not today. So for instance, if I increase my inventory today, well, I have to spend money to do that, so that's a cash outflow. But I do know eventually I'll sell that inventory and I'll bring cash into the firm. So when we add net working capital, we hurt our cash flow temporarily, but we know in the long term we'll get the cash back. And it's one of those things you have to have it to support sales. So it's not necessarily a necessary evil, but you can think of it that way if you want. Now current liabilities are money that I have to spend in the current time frame. And the most common one is product inventory. Now sometimes people think about things like accruals or other items, but for our purposes in FINA 3000, we'll think of net working capital is essentially cash plus accounts receivable plus inventory minus accounts payable. Now I have a slide here for adjusting cash flows for inventory. So when I get done talking about this briefly, you might want to pause and read through this. But anytime I add inventory, I have to spend cash to get it done. So when I increase inventory from period to period, I'm investing cash flow. So it's a cash outflow for the firm. Accounts receivable. When I make a sale, it always shows up on my income statement as revenue. The problem is some sales are in cash, some are on credit. When I make a credit sale, I don't get paid cash immediately. I get paid cash 20, 30, 40 days from now. So eventually I'll receive cash, but in the moment when we think about today's cash flow, I've given up a good or a service and have not been compensated yet. So when accounts receivable go up, our cash flow goes down. Now accounts payable is a current liability, and it's money that I owe my vendors or suppliers in the current time period. So it's a cash outflow right now. But when I run an account payable, I haven't paid yet. So I've received a good or service that I haven't paid, and I won't pay for maybe 20, 30, 40 days. So think of this as the opposite of inventory or accounts receivable. When I increase my accounts payable, I've delayed paying cash. So this actually helps my current cash position. Now you might say to yourself, well, why don't we just max out accounts payable and not pay anybody today? Well, when you start doing that with people who work for you or suppliers, you don't tend to get supplied as much anymore or on time. So it's one of those things you need to actively manage. To calculate net working capital, it's simply current assets minus current liabilities. So cash plus accounts receivable plus inventory minus accounts payable minus accruals. Big item here. Net working capital is a balance sheet entry. So what does that mean? Well, it means that a balance sheet tracks a firm's financial position at the moment. So if I wanted to know what happened in any of these accounts over the past year, I'd need a starting point and I'd need an ending point. So for instance, let's say today is June 30th. We should be somewhere at that point in the semester. So June 30th, 2013. If I want to know how much money I've spent on inventory in the last year, I would compare today's value versus the value on June 30th, 2012. The difference is the net investment in inventory. Because these accounts are fluid. Money comes in, money comes out all the time. We want to know the net impact. So we sort of calculate what we call delta net working capital, which is simply the net working capital today minus the net working capital last year. To add to our cash flow equations that we've developed so far, we add it after our operations cash flow. And you can tell we go in there and we say subtract the change in working capital. So if net working capital gets bigger this year, that means we've invested cash, so our cash flow should go down. So when net working capital goes up, cash flow goes down. That's a key concept. Let's look at a simple example. So we have a 2-year project, and we have net working capital values projected for the project for the starting value in years 1 and 2. For year 0, we've simply added 1,000 to our net working capital total. Well, think about that. That's a cash outflow of $1,000. So for our cash flow at time 0, we would subtract 1,000. For year 1, our net working capital at the end of year 1 is $1,200. But that's not the investment. The investment is the change. So the year started, that'd be year 0, at 1,000. So we went from 1,000 to 1,200. So our net change is $200. That's our investment. Our account got bigger by $200. So that means our cash flow went down net $200. We could do the same thing for year 2. At the end of year 2, I'm at $1,500. We started the year at $1,200. So the change for the year is $300. Right? It's not what the total is, it's how much I added to net working capital during the year. Well, if I started at $1,200 and I end at $1,500, I added $300 of value. That's net cash flow out. Now we need to think about what happens at the end of the project. Just suppose you were a car salesman or a car dealer, and you sold cars year-round, and eventually you decided you had had enough and you wanted to quit the business. Well, you wouldn't just walk away with a parking lot full of cars. You would try to sell them, and you'd get rid of that inventory at the end of your project. If people owed you money, you'd collect. If you owed someone money, you don't want a bill collector coming after you, you'd pay them. So the point is, when a project ends, we resolve our net working capital by zeroing out those accounts. The way we zero it is we collect the cash and pay what we owe people. So we convert net working capital to a cash flow, in other words. So the simple way to do this is just look at our balance sheet value of net working capital at the end of the project. So for our example, the net working capital at the end of year 2 is $1,500. That amount, in theory, can be converted to a cash flow. Now, in real life, we don't get 100% of our final balance sheet value of net working capital. We do the best we can. Most firms are historically between 60 and 90%. And as with the other problems, I'll try to give you a few extra problems up online to practice investment in net working capital.